Hey everybody, welcome to this free edition of our Trader User Group, a weekly roundup for the trading week ending August 13th, 2021. I'm Preston Brent. Thanks for tuning in, everybody. This week's theme is where will interest rates go? And I think if you knew that, then I'd want you to go to Vegas with me. Markets are a little bit confused about interest rates in the bond market, but first let's just take a look at where we've been and what's going on in the markets. We'll take a look at the equity and debt markets, and we'll take a look at a couple of charts here. So if we just zoom in on the week, and let's just look at some of the weekly sound bites. If we look at the index performance, you can see that for the week, everybody for the most part was in the green except for the Russell. It was the only one down, 1.16%. Year to date, everybody's in double digits, having a very good, strong year this year with S&P leading the way at almost 19%. Best sector performer for the week was materials, coming in at 2.75. Worst, energy, a rare instance where energy was down 18 basis points. Annual sector performance for the year, energy's been leading the way all year and continues to do so, up 33.13%. Excuse me. Staples is up also 8.78%. Now, if we look at the PE ratios and valuations, you can see that the forward 12-month PE ratio for the S&P is 22.37. It's still higher than the 10 and 15-year average. Dividend yields coming in at 1.32% for the S&P. Excuse me. 10-year Treasury is underneath the dividend yield for the S&P, coming in at 1.29%. Hang on just one second, guys. Sorry, I had to get a drink of water here. So where were we? So the dividend yield is higher than the 10-year Treasury. So that continues to funnel money into the equity markets. Okay. Current volatility VIX finished the week at 15.45. Like the market's grinding higher, the VIX has been grinding lower, although it still seems remained elevated higher than normal, being near all-time highs. The VIX fell 4 basis points for the week. The prior week it closed at 16.15. So all in all, markets continue to grind higher, net. And of course, if we look at some of the data points for the week, let's take a look at the economic data. Well, as I said, this past week the Senate passed a over $1 trillion bipartisan infrastructure package, which includes about $550 billion in spending on traditional transport infrastructure stuff. So if a bill does get passed, the markets do like that because it really gooses the U.S. GDP for any kind of government spending. Not as much as consumer spending, but if we take a look at it, and let's just take a look at some of the economic data and U.S. Treasury data. This past week, all eyes were on the inflationary data coming out of the Bureau of Labor Statistics. CPI increased by 50 basis points sequentially in July. Now, keep in mind that's a deceleration from 90 basis points in June, but it's the smallest month-over-month uptick in inflation since March, but it's still elevated. The core CPI, which you take out volatile food and energy costs, it came in at 30 basis points. So this slowdown in the inflation rate appears to not completely substantiate, but it just talk about the prevailing narrative of increases in our CPI data, which is inflationary, is going to prove transitory. I believe we're going to have some that's transitory and some that's sticky. I tell our members that wage growth tends to be more permanent instead of transitory. Although we did get PPI data this week coming in the next day after CPI, that increased 1% for the second consecutive month. That's the highest uptick in PPI than many economists had forecasted. Let me get another drink of water, guys. It's killing me. Got something stuck in my throat. So we're getting some strong economic data, but inflation still remains hot. Although Treasury yields, looking at Treasury, it climbed most of the week, and but then only to give a lot of it back on Friday when we got the really disappointing consumer sentiment survey from Michigan, University of Michigan. It came in much lower. So that man, I'm dying here. So that really sent the bond um, futures market higher and interest rates lower. But I still think that in and of itself is transitory. I think interest rates are going to slowly grind higher outside of these independent spikes that we're getting. Okay. And if we come over and look at Europe, just kind of see what's going on over there. Let me show you just how it kind of fared. Everything was in the green across Europe. The Euro stocks, which is the 50 largest companies across Europe, up for the week. FTSE was up, CAC 40, DAX, all of them solidly in the green. Year to date, solidly. Look at the CAC 40, it's up 24.22% year to date, very strong. The only index in the red year to date is China and Hang Seng. Okay. If we go back to Europe for a second, though, we're seeing expansion in the UK. It expanded about 4.8% in Q2. And the quarterly rate was, even though it came in at 4.8, it was a little bit below the Bank of England's forecast of 5%. Their GDP is 4.4% below where it stood at the end of 2019, right before COVID. So they're lagging a lot of other advanced economies, but primarily because they've stayed shut down for a long period of time. Same thing over most of Europe. That's why the U.S. is leading pretty much everywhere, because we got a lot of states in the U.S. that refuse to shut down, which I think is the right thing to do. We did get industrial production in the Eurozone that came in a little bit, 30 basis points down in June. Again, the issues, according to most analysts, are supply chain bottlenecks, is what we're seeing there. Revised data from EU Statistics Office pegged the contraction in the Eurozone industrial production in May at 1.1%, down from the previous estimate of a 1% drop. So all in all, Europe is expanding, but at a very slow rate. And like the US, it's kind of a grind mode. It's kind of what we're seeing. Okay. And of course, let's talk about Japan for a minute. The Nikkei did finish in the week 56 basis points higher, and just barely. The Asian markets, the Nikkei is above zero year to date, just 1.94%, as you can see. Both China and Hang Seng in the red year to date. That's because China clamped down on all things technology and education in that country. They fear giving a lot of power to any business endeavor. They want to control all the power, so they kind of took it away, and that crashed their market, putting them in a almost a bear market. But they're hanging on now. They've clawed back a little bit, but they're still below zero for the year. So the government oversight is just continuing to just tie a noose around, like I said, technology and private education industries, right? China did add 2.38 million manufacturing jobs, but they lost 9.16 in services, which would make sense. They're shutting down. They're having trouble with the COVID, like they are in Japan. They just seem to have more new coronavirus cases, and they're quick to shut things down, and that is going to be reflected in the economic growth and the data that we're seeing. Okay. So we're also seeing the PPI data in China coming in. It's 9% year-over-year surge in the PPI, mostly driven by higher commodity prices. We did see CPI go in at 1.3%. So, inflation is going to touch all major countries, all right? Some of it is transitory, I agree, but some of it is not. And we're really going to be able to shape that narrative in the next 90 to 120 days. It takes a little bit of time as these supply chains kind of unkink themselves. But I do believe inflation is going to stay higher for longer and be worse than people think, which is going to force the Feds to action here shortly. What I want to do is take you guys over the charts. Let's just take a look at some of the key charts here. And we'll go through these main charts here for this weekly roundup. For members this Sunday evening, we'll go into more detail on other sectors and ratio charts and other things where I think there could be some opportunities coming up for us as we go into the August-September timeframe, which traditionally has not been that favorable for the markets. Actually, it's July, August, September are just not good months for the market. Now, for most of you guys, you know I've been calling for anywhere from a 7 to a 12% pullback. I've scaled that back to 5 to 10%. But there's just so much money flowing into the market right now. There truly is no other place to put the money. So we're seeing these asset bubbles. I don't want to use the word bubble, but let's just say valuations that are very high, which means earnings need to be stronger and stronger. And I think we've come into peak earnings growth, meaning Q3, Q4, Q1 going forward, earnings are going to come in at a rate of change lower than what we've seen before. And that is going to have a tendency to pull the markets back and reestablish and reset some PE ratios and valuations. All right. It's just only natural because we can't keep growing at this rate. Even if you put more money into the market and you put on top of it, the Feds are going to start talking about quantitative tightening. We've been in a QE mode since March of last year when the Feds reacted very quickly to the COVID crisis. Even stronger than they did in 08 and 09 with the great financial reset. So there's just a ton of money sloshing around there, and I think they're going to box themselves in a corner, and it's going to make for some very sharp down moves in markets and sharp increases in volatility. For now, we're grinding higher. I'm telling our members, you want to remain long, keep position sizes not as large, normally 50% to 60% is your normal size, and be quicker to take profits. If you look at the markets here, this is a chart of the E-mini S&P 500 futures. You can see Friday we made new all-time highs, 44.63. Now, if you guys remember in the summer, I called our target when the markets were down around 3,700. I'd said our target would be 41 to 43. And I know when I put it out there, people thought I was crazy, being very aggressive. And we just, we blew right through both of them. And now we're up at 44.63. I've got a revised target for the markets around 4,600 by the end of the year. But I do believe we still should have a 5 to a 10% pullback in order to get us there. That'll kind of shape things up. You can see we're well north of the 50 EMA, even further north of the 200 EMA. So that does set up from some downside. But right now, there's just money loving the markets. So you got to remain bullish, okay? If we look at the Dow, also looking at this, we made new all-time highs on Friday as well. It finished about flat. The futures was down just 1 point. The Dow Jones index was finished at 15.53 for the day. But you could see during that day we made all-time highs. All right, 35,519. Well north of the 50 and the 200. The 50 is going to be the first area of support for most of the major indexes. So I would like to see a 5 to 7% pullback over the next 3 or 4 weeks. Perhaps we'll get it as we round out August going into September. And it won't take very long to get there, okay? And of course, if we look at Nasdaq 100 futures, it is riding along the top. Its last all-time high was made on August the 5th, almost a week ago, a little more than a week ago, all-time high, but it hasn't really given it up, right? We've seen some of the sector rotation out of mega cap, tech, and growth going into mid cap and other leaders in the market, and they've shifted a little bit, right? Which is a sign of a strong market. The only thing that is not a sign of the strong market is if we look at the Russell here, and this has got me a little bit concerned. Notice the Russell attempted again to climb over the 50 EMA. This is this red line, and it could not do it. We never could get escape velocity and move higher. And then on Friday, it closed hard down 23.40, right? That's over a 1% move lower just on that day alone. That one day pretty much wiped out a week's worth of movement. And you could see it covered all the way down, and we closed at the low trading price just about for the week in the Russell. And we're back below the 50 EMA. I said, and I told our members, if we fail this move right here as we were broaching the 50 EMA, it's going to be a little bit more bearish going forward. And that could be a sign as we round out the month of August that we're going to be predisposed to a little bit of a lower move lower. Now, what could move the markets lower? Well, the markets just, they trade the future expectation. So if that expectation changes, it will change the movement and the rate of change of that future price move, either up or down. So we've got a number of areas that could change the expectation of what the markets expect can happen over the next 90 days. The most primary one coming up, not next week, but the week after. All right. That's when the muckety mucks, that would be the central banks of the major countries from Japan, Canada, the US, Great Britain, the ECB, all of them get together in Jackson Hole, Wyoming, and then they come down with their tablets from the mountain and they tell us all what we should expect from them over the coming year. They very rarely get a 90-day forecast right, so I don't know what's to make of a 1, 2, 3 year forecast. But it doesn't really matter what I think or you think. It's how the market price action interprets their actions, because their actions, they try and give the markets a heads up as to how aggressive or soft they will be in their quantitative tightening. It is time for quantitative tightening. It's been time for quantitative tightening. The U.S. real estate market is on fire, and they're buying $40 billion of mortgage-backed securities every month, $80 billion of U.S. Treasuries every month. So I do believe at this Jackson Hole, Wyoming, they will either lay out a plan or talk about their September FOMC meeting when the Feds meet and lay out their plan. Now, if they come in more aggressive than the markets expect, you can expect a 5 to 10% pullback over a 2 or 3 week period. It won't happen. It won't take very long. Then the buy the dip crowd will come in, and then I'll be more aggressive in buying that dip. So that's why I say keep your position sizes and keep some dry powder in the bullpen ready when we do get that dip. Otherwise, you're still playing the upside, but you're just being careful how you do it. Okay, so the Russell small cap typically leads the markets up and down. And let's look at the Dow transports. Look at the transports. We broke this regression channel to the upside. And you can see on the 50 EMA, if I blow it up, again, just like the Russell, we cleared it. We came right down and we're sitting right on that 50 EMA right now. My target for the transports near-term Elliott wave count would put us around 242. If we come down here, that's testing the 200. That'll show a lot of weakness in the logistics system of the U.S. and globally, actually, and transport system. And that traditionally leads the markets up and down. And it also kind of leads with the small cap, right? Although this is more downside aggressive move. Right? So we just got to watch this very closely. You typically don't see the transports moving down like this when we're making all-time highs. That just shows that as we shift sector rotation in the equity markets, we're being led by fewer and fewer stocks. Still enough to keep the markets moving higher because there's a lot of money flowing in, but it's flowing into fewer and fewer equities. Okay. So that's a little bit about what I see across these areas here. If we look at the Fang Index, the one that I've customized, this index is comprised of Microsoft, Facebook, Apple, Netflix, Google, and Amazon only. You can see we haven't made an all-time high here in this index since the end of July. So it's just kind of peeling back, and we're being led by other sectors, other different stocks than the big guys. Okay, so we need these guys to have a rest, but we're not really in the throes of coming up on a bear market. Typically, a bull market comes to an end as fewer and fewer stocks lead the way higher, and then when those stocks give it up, the slack is not picked up by other lagging stocks. In fact, the other lagging stocks fall even harder as the leading stocks that pull the market higher roll over. Okay. We're not seeing that right now. I'm not seeing that right now. So that's why we still are in this grind mode. And use any pullback as a buy the dip to jump in. Okay. Now, if we come down here and we look at vol, if we look at the volatility index right here, you can see in the vol index, we're just grinding lower each day, just a little bit lower in the VIX. Okay. But we have not been out of the yellow for quite some. The last time we were in the green was back over here pre-pandemic. After the pandemic, it just changed the whole market, right? And if you look over here, and let's just zoom back out again, the yellow zone is a choppy market zone, all right? The green is generally quiet up. We're grinding higher, and you say, well, it's quiet, but in many respects, it's not. Underneath the surface, we're getting some big sells, big moves, but other stocks are taking over. And when we get down here, if we can get down into the green, that would be better news. But the fact that the volatility is remaining bid, meaning people want to buy vol as a hedge, just tells me that the markets are still nervous. So we have to watch it very closely. And of course, let's look at Treasuries. Bond market had a huge up day on Friday, closing up 1 in 29 ticks. Right, that's a big move up. You can see where it came down, kissed the 50 EMA, came up and it kissed the 200 EMA. I do believe it's kind of a. I don't think we're going to run back up here. I think it's going to kind of run sideways and then start to come back down again. So that would mean I still believe the bond market is going to go lower over the next 90 days. Now, I have said if the markets pull back, bonds will move higher, but that'll be a short-term move, and you want to look ready to jump in and sell it. That would be how I would want to play the bond market. And if we look at the interest rates, it's going to be just the opposite of bonds. You can see here how the rates came right up, hit the 50 EMA, and just could not get enough momentum to clear it. And then it's coming right back down again. So I don't think interest rates will go that much lower. It's going to catch itself, and it should run steady to up. Okay. But if we do get, again, that pullback in the markets that I'm expecting over the next 3 to 6 weeks, we're going to see interest rates come back lower. Okay. So that's a little bit about what I'm seeing there. And if we look at the dollar, again, the consumer sentiment really concerned the markets big time. Look at that big down move in the dollar, right? We're also setting up for a poor man bearish divergence. So a poor man bed means typically we're going to see more downside. You can see the cross in the 50 over the 200. That cross is typically a resistance and or support point. In this case, it'll be a support point. But that would suggest the dollar index is going to move a little bit lower. Okay. So we're going to just kind of see how that plays itself out. And then, of course, if we come down here and we look at metals, if we look at gold, gold had a strong day on Friday. We cleared, typically when you have a pattern like this, okay, if you look at this pattern right here, you can see here it's a symmetrical triangle. We approach the pattern from the bottom up, so the typical break is to the upside. Doesn't mean you can't have a downside break, but the typical break is upside. But you can see here in this downside break, it was almost like a flash crash. We came all the way down, tested these levels here. We got a bullish divergence, so I think gold is going to glide its way back up here, get inside this triangle, and run this a bit longer before it breaks as an upside break, right? That's kind of what I'm looking at on the gold market right now. I am playing gold long, but I'm doing it using options on gold futures, and I'm doing it in a way our members understand that allow us to adjust fairly easily. And we just move this thing out. If we have to roll it out to 2022, I'm not concerned about it. I do think gold will slowly make its way back up Right now, though, it's just sitting here. So I don't see too much in gold other than neutral to slightly higher. Okay. Same thing with silver. Copper, we got a trade on in copper. You can see this long-term trend line right here going all the way back to April of last year. We got long copper back over here in early April after the March crash, rode it all the way up. It was one of our best post-pandemic trades. Some of our members took copper futures and made a fortune on that. We stayed in, and I directed most of our members to play Freeport-McMoRan, which is almost a proxy for copper. But you can see we generally come down. If we get too far north of the trend line, we typically come back to it. You can see the 50 EMA, which is the red line, is kind of paralleling just north of the trend line. And now, if you can, I'll just blow it up here. You can see where we've come down and we're testing it, and the 50 EMA and price level, they're almost stuck. Now, if we break this to the downside, the first test is going to be slightly above 4 at this key pivot point right over here, just north of the 200 EMA. But I do believe that as long as the global economy is sound, and even if we have that 5 to 10% dip, I think the global recovery is going to continue. We're going to grind until 22, maybe going into 23, and then we're going to have a hellacious bear market. More on that for our members later. If you're not a member, I highly encourage you to come in, because some of the most money we've made as a user group is in bear market activity. It happens fast. Money just piles up really quick if you understand it and how to trade a bear market. We will have that again, guys, and it's going to be an ugly one, but not now. Right now, we're still in a buy the dip. Okay. If we come down here and look at energy, it's kind of moving the way I'd said it was going to move. When we hit this Elliott wave 3 up here, I said fade this move. A lot of our members just played it to the downside using condors or iron condors or credit spreads. And then when we hit this move up here at this 5 leg, right up here at 76.98, Elliott wave 5, I said fade this move here too. Okay. To be fair, I was saying fade the move when we were around $75 a barrel. This was just an intraday move up and back down again. It never really closed higher than 75.27. And I've told our members that the near term with oil is neutral to down. Okay, I said it probably will not go below 60. But again, if the economy is seen as slowing down dramatically, oil is going to kind of follow where the economy goes. And then, of course, if we look at nat gas, well, you guys remember what I said with nat gas. Up at these levels up here, next stop down is this touch point right here. Doing credit spreads in natural gas futures, to me, is the easiest trade. Right? It's kind of a low-hanging fruit trade in my mind, because I don't see it going much higher. Nat gas does not stay up here very long. If it does get up here, it's an anomaly, and then it rolls back over. Okay, so that's a little bit about what I am seeing in the markets right now. Members, I will see you this Sunday evening for our weekly market watch. For everybody else, if you're not a member, I highly encourage you to come in. Otherwise, I will see you next weekend for our weekly roundup. Take care, everybody. Ciao now.